Imagine you're working in a growing finance support team. It's the start of the year, and your inbox pings with an email from HR, 2025 retirement plan limits, please review. You glance at the subject line, groan, and think, what now? Well, today, we're turning that groan into a grin. Because we're about to decode the latest retirement plan updates from the IRS. The kind of update that shapes contribution limits, savings decisions, and compliance rules for millions of people. Welcome to the 401(k) Hub, where complex retirement concepts are broken into human stories. One update at a time. Today's episode is based entirely on IRS Notice 2024-80. Which sets the cost of living adjusted limits for 2025 on everything from 401(k)s to IRAs, simple accounts to catch-up contributions, and even the new Roth rules. Let's step into the shoes of our fictional character, Neha, a back-office associate in a BPO working with 401(k) transactions. She's just been promoted to a compliance-facing role and now needs to understand these updated limits. Let's walk alongside her as she learns. Magnifying glass defined benefit and contribution plans. Neha's first stop is learning about the overall contribution limits. For defined benefit plans, which promise a fixed payout at retirement, the annual limit in 2025 has increased to $280,000. That's up from $275,000 in 2024. For defined contribution plans like the 401(k), the maximum combined employer and employee contribution is now $70,000, a $1,000 increase from the previous limit. She realizes that these changes are not just numbers, they influence payroll systems, employer matching calculations, and plan compliance testing. Briefcase elective deferral and catch-up contributions. If you're an employee making contributions yourself, you'll want to remember these numbers. In 2025, you can defer up to $23,500 into your 401(k), 403(b), or the Thrift Savings Plan. This includes what you decide to set aside from your paycheck. Are you 50 or older? Great, catch-up contributions allow you to go beyond that limit. For most plans, that catch-up remains at $7,500. But for those aged 60 to 63, an enhanced catch-up limit of $11,250 applies. But here's the twist. If your income in 2024 was over $145,000, those catch-ups must be made as Roth contributions, which are taxed now rather than later. It's a game changer, and plans must track this rule very closely. Bank Simple and 457 plans. Neha also notes a bump in simple account contributions. The basic salary deferral limit moves from $16,000 to $16,500, and the top limit, based on employer design, remains $17,600. For 457 plans, often used by state and local government employees, the elective deferral limit also rises to $23,500, matching the 401(k). Busts in silhouette highly compensated and key employees. To keep plans non-discriminatory, it's essential to track who qualifies as a highly compensated employee. That income threshold is now $160,000. If you're a key employee under top-heavy plan rules, that number jumps to $230,000. These thresholds help ensure that plans don't unfairly benefit top earners over regular workers. Stop-sign IRA contribution limits and income phase-outs. Individual retirement accounts, IRAs, have their own set of limits. While the maximum traditional IRA contribution stays at $7,000, the income thresholds for deductibility have shifted. For example, if you're a single filer and an active plan participant, the deduction phases out between $79,000 to $89,000. If you're married filing jointly and covered by a plan, the phase-out starts at $126,000. For Roth IRAs, you can contribute fully until your joint income hits $236,000, phasing out at $246,000. Neha learns that advising employees on these ranges is critical, especially during open enrollment or when advising on Roth conversions. Savers credit and other limits. Don't forget the Savers credit, a tax break for low and moderate income workers saving for retirement. It now applies for Married couples with incomes up to $79,000. Heads of household earning up to $59,250. Singles earning up to $39,500. And, if you're using a longevity annuity or making qualified charitable distributions, there are updated limits there too. Like a $210,000 cap on premiums and $108,000 cap on QCDs. Bookmark tab's final thoughts. As Neha closes her guidebook, she realizes just how impactful a single notice like 2024 to 80 can be. These numbers affect everything from individual savings to plan design, IRS testing, and long-term retirement security. And now, you do too. These limits are more than just compliance updates. They're a map, a signal, a way for plan sponsors, payroll teams, advisors, and participants to steer retirement plans in the right direction. But remember, this podcast is for educational purposes only. For the latest and most detailed guidance, always refer directly to the IRS and Department of Labor websites. Headphone thanks for listening to 401 KDC Hub, your backstage pass into the world of retirement plans. In our next episode, we'll explore how these limits impact compliance testing and plan qualification rules. Stay tuned. If this episode helped simplify the complex, give us a follow on YouTube or Facebook, and consider sharing this with your peers. Till then, keep learning, keep saving, and keep growing.